Friends, thank you for being here today. What if I told you that the single greatest threat to the global energy transition isn't a lack of political will, but a simple element on the periodic table that everyone has forgotten? What if the electric vehicle revolution, currently stalling due to range anxiety and safety fears, is about to be jump-started by a technology that mathematically guarantees a global shortage of one specific precious metal? For years, the narrative surrounding the green energy transition has been dominated by lithium, cobalt, and nickel. We have been told that these are the battery metals of the future. We have watched their prices soar and crash, and we have listened to pundits debate supply chains and mining rights in the Congo and the lithium triangle. But while the world was distracted by the lithium narrative, a quiet revolution has been taking place in the R&D labs of South Korea, a revolution that fundamentally alters the chemistry of energy storage. Samsung SDI, one of the world's premier battery manufacturers, has dropped a silver bomb on the global supply chain, and the shockwaves are only just beginning to ripple out. This is not a story about speculation or hype. This is a story about physics, chemistry, and the unyielding laws of supply and demand. It is the story of how silver is moving. From being a mere industrial spice used in trace amounts for its conductivity to becoming a structural component of the battery itself. Today, we are going to dive deep into the mechanics of this shift, the extinction equation it creates for global silver reserves, and the strategic implications for the global economy. To appreciate the magnitude of this shift, we must first examine the technological breakthrough that solves the industry's most persistent problem, the dendrite dilemma. To understand why this shift is inevitable, we must first understand the fatal flaw of current battery technology. For 3 decades, the world has run on liquid electrolyte lithium-ion batteries. From the smartphone in your pocket to the Tesla Model Y in your driveway, the fundamental chemistry has remained largely the same. These batteries are marvels of engineering, but they have reached their theoretical limits. They are heavy, they are sensitive to temperature, and most critically, they are flammable. The holy grail of battery research has always been the solid-state battery, or SSB. The promise is seductive: a battery with no liquid electrolyte, no risk of fire, instant charging, and double the range. Every major automaker, from Toyota to Volkswagen, has been promising this technology for a decade. But until recently, they all failed to overcome one specific chemical adversary: the dendrite. When a lithium battery charges rapidly, or when it undergoes many charge cycles, lithium ions tend to plate unevenly on the anode. Instead of a smooth layer, they form needle-like, jagged crystals known as dendrites. These microscopic spikes grow like roots, eventually piercing the separator, the safety wall between the anode and the cathode. When that barrier is breached, you get a short-circuit, thermal runaway, and the catastrophic fires that we occasionally see on the news. This is why current EVs are software-locked to charge slowly. It is a safety mechanism to prevent dendrite formation. Enter Samsung SDI and their silver-carbon nanocomposite layer. Researchers at Samsung discovered that silver possesses a unique property when interacting with lithium. It doesn't just sit there. It acts as a perfect host. When applied as a nanocomposite layer on the anode, silver allows lithium ions to dissolve into it evenly. It regulates the deposition of lithium, forcing it to spread out smoothly rather than building up into jagged spikes. In essence, the silver layer acts as a gatekeeper, completely stopping dendrites cold. This is the breakthrough the industry has been waiting for. By using this silver carbon layer, Samsung has enabled a battery architecture that is safer, smaller, and vastly more powerful. The specifications confirmed by Samsung are staggering. We are looking at a vehicle range of approximately 600 miles over 900 kilometers on a single charge, effectively doubling the current standard. We are looking at charging times dropping from 45 minutes to just 9 minutes, making the EV experience comparable to filling up a gas tank. The lifespan of the battery extends to 20 years, meaning the battery will likely outlast the car itself. And critically, the energy density jumps to 900 watt-hours L, allowing for battery packs that are 40% lighter and smaller than their lithium-ion predecessors. But as with all great leaps in engineering, there is a catch. This technology works perfectly, but it requires silver. And not just micrograms of it. It requires grams and potentially kilograms of silver for every single vehicle. This brings us to the core of the issue, a phenomenon I call the silver bomb, which is defined by the mathematics of a massive demand shock. The implications of this chemical shift are profound. To grasp the magnitude of this, we have to look at how silver has been used historically versus how it will be used in the solid-state era. For the last century, silver has been an industrial spice. It is the most conductive metal on Earth, so we sprinkle a tiny bit of it on circuit boards, light switches, and solar panels. In a standard internal combustion car, you might find 15 to 20 grams of silver in the window motors, defrosters, and electronics. In a current electric vehicle, that number rises to about 30 to 50 grams due to the increased electronic complexity of battery management systems and inverters. This increase alone has been enough to push the silver market into a deficit. However, the solid-state battery changes the nature of silver's role entirely. It moves from being an auxiliary conductive material to being an active material in the electrochemical storage process. It becomes the DNA of the battery anode. Let's run the numbers based on the technical papers and early estimates. Conservative estimates suggest a silver loading of about 5 to 10 grams per kilogram of anode material. For a standard EV battery pack, this adds roughly 50 to 100 grams of silver per car. That sounds manageable until you multiply it by the scale of the global auto industry. But the numbers get truly frightening when we look at high-performance vehicles. The American market loves big trucks and SUVs vehicles like the Ford F-150 Lightning or the Tesla Cybertruck. These require massive battery packs. Aggressive estimates suggest that for these high-range, high-performance packs, the silver content could reach as high as 500 grams to 1 kilogram per vehicle. Let's take a middle ground scenario. Suppose we achieve a 20% global fleet penetration of solid-state batteries. The world produces roughly 90 million cars a year. If 18 million of those cars switch to solid-state tech using a moderate silver loading, we could see a sudden surge in demand ranging from 30 million to over 100 million ounces of silver annually. To put that in perspective, the entire global mine supply is roughly 830 million ounces. A single new technology sector has the potential to consume 10% to 15% of all the silver mined on Earth, and this is just at 20% adoption. Strategist Kevin Bambro has crunched the numbers further, projecting that if solid-state batteries become the standard, the auto industry alone could eventually consume up to 2/3 of global annual production. The terrifying part for manufacturers is that this demand is inelastic. In the past, when the price of a material spiked, engineers would thrift it out, finding ways to use less of it. We saw this with silver in solar panels. Over a decade, the amount of silver per panel dropped significantly. But you cannot thrift the silver out of a solid-state anode without consequences. Chemistry is stubborn. If you reduce the silver loading below the critical threshold, the dendrites return. If the dendrites return, the safety guarantees vanish, and the battery becomes a fire risk again. Therefore, auto manufacturers will be forced to buy the silver regardless of the price. They are hostage to the periodic table. However, this surging demand is colliding head-on with a supply chain that is already at its breaking point, creating what can only be described as the Extinction Equation. The silver market is already in a structural deficit. For the fourth consecutive year, global demand has outstripped global supply. The insatiable appetite of the solar industry, combined with relentless electronics demand and retail investment, has already drained the market. We are burning through 50 to 100 million ounces of above-ground stockpiles every year, just to keep the lights on. The vaults in London and New York are bleeding inventory at a historic rate. So, where does the new silver come from for Samsung's batteries? Can we just dig more? The answer lies in the concept of the geological wall. Mining is not like software. You cannot just code a new mine into existence. It takes, on average, 10 to 15 years to take a mineral discovery from the initial drill hole to a producing mine. Even if the price of silver jumped to $100 tomorrow, it would not result in a single extra ounce of supply for a decade. The supply is inelastic in the short to medium term. Furthermore, the quality of the mines we do have is collapsing. In 2005, a high-quality primary silver mine might have had an ore grade of 15 ounces per ton. Today, miners are lucky to find 4 ounces per ton. We are having to move 4 times as much earth, burning 4 times as much diesel, and using 4 times as much water to get the same amount of metal. This is the law of diminishing returns in action. The skeptics often point to recycling as the savior. We will just recycle the silver from old cars, they say. This is the recycling myth. While gold is recycled at a rate of nearly 90% because it is concentrated in jewelry and bars, silver is recycled at a rate of less than 20%. Why? Because of dispersion. Silver is the vampire dust of industry. It is scattered in microscopic quantities across billions of discarded electronics, landfills, and waste sites. Recovering 0.1 grams of silver from a smartphone often costs more energy and money than the silver is worth. Moreover, there is a sequestration lag. If Samsung puts 500 grams of silver into a solid-state battery in 2026, and that battery lasts 20 years, that silver is effectively removed from the market until 2046. It is locked away. It cannot be recycled because it is still in use. The recycling wave will not arrive in time to alleviate the crunch of the 2020s and 2030s. I want to pause here and ask you a question. Given the geological wall and the recycling limits we just discussed, do you believe the auto industry is sleepwalking into a crisis, or do you think they have a secret stockpile we don't know about? Let me know your thoughts in the comments section below. Finally, we must consider the geopolitical risk. The majority of the world's silver comes from Latin America and countries currently under sanctions. Mexico, the world's top producer, has effectively stopped issuing new open-pit mining permits. Peru is plagued by labor strikes and political instability. As silver becomes a critical strategic metal for the energy transition, we run the risk of resource nationalism. Governments may realize that selling their silver cheap is a strategic error. They may impose export bans, demand higher royalties, or even nationalize mines to ensure their domestic industries have access to the metal. You might be asking, if the fundamentals are so bullish, why is the price of silver not already skyrocketing? This brings us to the great disconnect in market dynamics. The price you see on the news is the COMEX price. This is a price derived from the trading of paper, contracts, futures, and derivatives that often have no physical metal backing them. Banks and institutional traders trade billions of ounces of paper silver daily, settling in cash rather than metal. This allows them to manage volatility and, some would argue, suppress the price despite the physical tightness. However, reality always wins in the end. We are starting to see the cracks form through mechanisms like the Shanghai arbitrage. In China, the Shanghai Gold Exchange is a physical delivery market. Because China is the epicenter of solar and battery manufacturing, their industrial demand is voracious. Often, the price of silver in Shanghai trades at a significant premium, sometimes $5 or more, above the Western spot price. This creates an arbitrage opportunity. Traders buy physical silver from the West and ship it to the East to sell for a risk-free profit. This mechanism acts as a vacuum cleaner, sucking physical metal out of the West and moving it to the manufacturing hubs of Asia. The Western markets can play their paper games, but they are slowly running out of the chips required to play. When the auto giants wake up to the Samsung reality, they will not be buying paper contracts. Ford, GM, and Toyota will need physical atoms. They will bypass the COMEX entirely and go directly to the miners. We will likely see a wave of strategic partnerships where car companies buy equity stakes in silver mines just to secure their supply chain. This is when the panic buying phase begins. A $600 increase in the cost of silver per car is irrelevant to a car maker if the alternative is not having a battery at all. They will pay the price, and they will pass it on to the consumer, absorbing the cost because the performance benefits of the solid-state battery justify it. This economic calculation, however, is only one half of the equation. We must now turn our eyes to the geopolitical chessboard, where a silent war for control of this strategic metal is already being won by a single dominant player. While the Western world has been debating ESG mandates and setting ambitious net zero targets for 2035, China has been quietly executing a multi-decade strategy to corner the physical market for critical minerals, and silver is the linchpin of this master plan. We often talk about China's dominance in rare earths, but their stranglehold on the silver processing supply chain is equally alarming and largely ignored by Western policymakers. China currently refines the vast majority of the world's silver and controls over 80% of global solar panel manufacturing. This gives them a first-mover advantage that is nearly impossible for the West to overcome in the short term. They have built a vertically integrated supply chain where the mine, the refiner, the battery factory, and the EV assembly line all within their sphere of influence. Consider the strategic vulnerability this creates for Western automakers like Ford, General Motors, and Volkswagen. These companies operate on just-in-time delivery models, assuming that raw materials will always be available at the market price. This model is fragile. In contrast, China operates on a just-in-case model, accumulating massive strategic stockpiles of copper, gold, and now, undoubtedly, silver. When Samsung SDI, a South Korean company, announced this battery breakthrough, it was not the New York hedge funds that reacted first. It was the industrial procurement officers in Shanghai. They understand that he who controls the silver anode controls the future of transportation. The West is effectively sleepwalking into a silver curtain scenario. We have seen China recently restrict exports of gallium, germanium, and antimony critical metals for semiconductor and defense industries, citing national security. What happens when they apply this same leverage to silver? If the solid-state battery becomes the global standard, silver becomes a matter of national security for every industrialized nation. Imagine a scenario where the Shanghai Gold Exchange begins to dictate the global price, decoupling completely from the paper derivatives traded in New York and London. In this world, the Western spot price becomes irrelevant because you cannot actually source metal at that price. The real price is the one paid in Shanghai, likely in yuan, bypassing the US dollar entirely. This geopolitical checkmate forces Western governments into a corner. They cannot allow their domestic auto industries to collapse due to a lack of silver. This inevitably leads to government intervention, strategic stockpiles, subsidies for domestic mining, and potentially the nationalization of resource output. We are already seeing the early signs of this with the U.S. Department of Energy as critical materials list. But lists do not dig mines. The West is 10 years behind in building the infrastructure required to process this silver independently of Chinese supply chains. This structural weakness ensures that the silver bomb will not just be an economic event. It will be a geopolitical crisis that reshapes global alliances. The squeeze will not just come from the geology of the Earth. It will come from the deliberate policy decisions of our strategic rivals. Before we pivot to the investment strategy that can help you profit from this shift, if you are finding value in this deep dive, please take a moment to hit the like button and subscribe to the channel. It helps us bypass the algorithm and get this critical data to more investors. Given this backdrop of technological scarcity, market dislocation, and geopolitical maneuvering, the question becomes, how does one navigate this coming storm? Let's look at the strategic investment playbook. First and foremost is the strategy of physical silver. In an industrial shortage, the form of the metal matters. You should prioritize weight over art. While collectible coins and numismatics are beautiful, their premiums tend to vanish during a true industrial melt-up. When Samsung needs silver, they need the raw element to melt down into nanopowder. They do not care if the silver is stamped with a picture of a superhero or a historical figure. Therefore, the smart money moves into 100-ounce bars, 10-ounce bars, and recognized sovereign bullion like maples or eagles. These offer the highest density of metal for your dollar and are the most liquid for eventual resale to industrial buyers or refiners. The second lane is mining stocks, but here you must be incredibly selective. There is a trap known as the hedging book. Many mining companies, fearful of price drops, have pre-sold their future production at today's low prices. If a miner has sold their 2026 production at $30 an ounce and silver hits $100, that miner makes zero extra profit. You must audit the financial reports of these companies and look for unhedged primary silver miners. These are the companies that will experience massive operating leverage. If their cost to mine is $20 and silver goes from $30 to $90, their profit margin doesn't just triple, it explodes by 700% or 800%. Furthermore, you must apply a jurisdiction filter. A gold mine in a war zone is worth zero. A silver mine in a country that is likely to nationalize assets is a liability. You want exposure to Tier 1 jurisdictions, Canada, the USA, and Australia. Not only are property rights secure here, but these nations are considered friendly for supply chain tax credits. Clean silver from Nevada will trade at a premium over dirty silver from sanctioned or unstable regions because auto manufacturers need to meet regulatory requirements to qualify for subsidies. Finally, we must discuss the exit strategy. No trend lasts forever. Commodity supercycles typically last 7 to 10 years. While silver is the answer today, technology moves fast. We must remain vigilant for the next disruption. Perhaps in a decade, we will see graphene anodes that require no silver or sodium-ion batteries that render lithium obsolete. The wise investor rides the S-curve of adoption. You accumulate now while the deficit is structural and the technology is launching. You hold through the mania phase when the headlines are screaming about shortages, and you look to rotate your profits into tangible, cash-flowing assets like land or real estate when the market becomes euphoric and the supply finally catches up or technology pivots again. Ultimately, the story of the energy transition is not just about wind turbines and solar farms. It is a story of the raw materials that make them possible. We have spent years focusing on the obvious candidates, missing the silent crisis brewing in the silver market. Samsung SDI's solid-state battery is not just a technological marvel. It is a forcing function. It is the catalyst that transforms silver from a precious metal used for jewelry and wealth preservation into a critical strategic energy, metal essential for the future of transportation. The math is simple, but the outcome is profound. The world does not have enough silver to replace the global fleet with solid-state batteries using current supply dynamics. Something has to give. The price must rise to incentivize new exploration, or the transition will stall. As investors, we are standing on the precipice of a historic repricing of one of mankind's oldest forms of money. The silver bomb has been dropped. The only question now is, are you positioned for the shockwave? Thank you.